Joining us now to discuss is the Guggenheim CIO, Anne Walsh. Anne, it's good to see you.
Good morning.
Welcome to the studio. Let's talk about it. The salespeople running around Davos trying to sell, saying things are really good in America right now and they could get even better. You've got to put money to work, and we're already priced for a lot of that. How challenging is it for you and the team?
Well, it is an interesting time. You've got rates that are range-bound. The 10-year trading between, we'll call it 375 and 475. You have credit spreads that are tight relative to history, and you have stocks that are stretched in valuation relative to expectations and at a risk premium that is less than zero. So it can be very tricky at this particular juncture. But fundamentals remain pretty strong, and so there's opportunity for investment in maybe a wide array of selections and sectors. So there's things to invest in.
I remember this sort of pendulum switching from bonds to stocks, people saying that stocks really seem like the dynamic place to be in a pro-growth administration at a time where inflation hasn't completely gone down. Do you agree with that, that stocks are preferable to bonds at a time where really growth is the main theme?
Well, I think that does give a lift to stocks, and as long as earnings per share projections turn out to be accurate, I think that there's still room for opportunity in equities. However, we also have to remember that not all markets are exactly the same. So if you look at the Russell 2000, you still have a very high percentage, around 40%, that are non-earners, and the Mag 7, of course, is well below risk premium levels that we've seen not since the late 1990s, where we had negative risk premiums. So I think that we have some risk associated with the market, that it is priced for perfection. So I would be cautious, but cautiously optimistic. And as long as, and we still see earnings per share rising, maybe not at the level that is priced into the S&P right now at 15% earnings per share growth, but nonetheless, still a fairly positive environment.
Stocks are priced to perfection, in your view. Are bonds priced to perfection?
No, actually, I think there's some real opportunities in fixed income still. We have a risk premium that's positive relative to, certainly relative to equities. And also, you're getting a real rate of return that is much better than we had pre-COVID. And you're getting a nominal rate of return in any number of areas that make a lot of sense. So we like all sorts of credit stories: structured credit, corporate credit, even high yield, and particularly the high quality portion of the high yield market. So there's still some real fundamental value that can be found in fixed income.
Can you say the same thing about treasuries?
Well, like I said, we're range-bound in treasuries, and there's a trade that's actionable there as we go up towards the top end of the range, in the high fours, if you will, 475. You can extend duration. You can then also, as we move back, shorten. After all, we saw a 120 basis point rise in the 10-year, and we were able to play that trajectory really quite nimbly, if you will, during that window of time.
The incoming government might have to look at extending duration as well. Will that complicate things? How do you think about the deficit concerns of the moment, and do you think that's been responsible for the pickup in yields we've seen through December and into the new year?
I think there's a couple things that have really influenced the rise in rates. One is the deficit, and it's a real concern. Who's going to buy all these bonds that we have to issue in the U.S.? Right now, we're still being able to be financed through both U.S. investors as well as international investors. So that story is still playing out pretty well. But at the same time, you also have a Fed that is sending mixed signals with regard to the rate trajectory. Now, our belief is that rates are still going to be moving down over the course of 2025, and we're going to move towards a neutral rate. And I think it's going to be tricky for the Fed to really find that perfect neutral rate. But at the same time, they are also still slowly reducing their balance sheet. So they're sending mixed messages, and they're also acting in mixed ways.
You know, John alluded to this idea that the U.S. has to finance all of this, and you were mentioning this, right? Where's the money going to actually come from? And we've talked about how that sucking sound of cash going into the United States to try to fuel this, crowding out some of the debt issuance and other assets in other regions. How destabilizing is it to have one economy accelerating so quickly and diverging from the rest of the world?
Well, It is unusual, but what I would also say is that because the strength of the U.S. economy has definitely been there, we continue to see an inflow of capital, and I think we're going to continue to see that. And the opportunity for investment is going to go beyond the markets necessarily and into infrastructure investment, manufacturing build-out, real estate.
For the U.S.
For the U.S.
But not for the rest of the world.
But not for the rest of the world so much. And so there's going to have to be some real balance there. But for the meantime, the U.S. is going to continue to attract capital.
Can we get you excited about Europe in any way, shape or form? We're sitting here in Switzerland.
It's beautiful.
It's beautiful. A lot of people say it's a great place for a vacation. I've always been told that by US-based investors. Can we get you excited about Europe at all?
I think that Europe has some real opportunity, but they have to really make some structural changes. And we'll see if Europe's able to do that. One of the areas of maybe concern or caution is that previously very stable governments are seeing some turmoil. France, Germany, elections coming up. And so I think that as we come through those and we see more evidence of the trajectory, and if we see a real desire for Europe to engage in structural reforms, then I think we might be able to see an investable opportunity.
There's a lot to fix, and I appreciate your time. As always, it's good to see you. Anne Walsh there, the Guggenheim CIO.